Hello, everybody, and welcome to the Trading with Ashley show. So today's video is going to be about how to earn a free leaps by selling put options to pay for the leaps. It's called a synthetic long, and I am actually going to do this trade for you. I did it for my community today on the ticker symbol DKNG. Now, I watched a video yesterday from my good friend Stocks with Josh, and he had shared with us that DraftKings typically rises in the fall as everyone's gearing up for sports betting. And when I looked back at the history, I could see exactly what he was talking about. So today was the perfect day to potentially do this trade that I want to show all of you, because it allows us to enjoy purchasing a leaps call option, but then we're compensated by selling the put call options that actually pay for it. So if this leaps continues to grow and if it doubles in value, then I would have effectively gotten it free. Now, free is the term I am using because I am creating premium that is paying for the leaps itself. But I want to talk about the risk before I get into the trade. So both of these strategies, both purchasing a leaps and then selling put options, they're both bullish strategies. You're of the belief that the stock is going to continue to rise past the point at which you purchased the leaps and sold the puts. So the risk in this trade is, because they're both bullish strategies, if I purchase the leaps and it does not rise and I do not end up making a profit, then I've lost money on the leaps. And so then you also have the sold put options. So if DraftKings goes below my strike price by my expiration date and then keeps tanking, then I can lose on that trade as well. So I was very careful on the strike price that I selected for the sold put, because ideally, if I am put the shares, then all I have to do is wait for the stock to rise, and then that puts me back in profit. So I wanted to discuss the risk before I get into the trade. The other thing to consider is, if you are going to be selling a put option, then you will need the cash or a combination of cash and margin to secure the trade. Because if I am going to sell a put, then I must have enough money to purchase 100 shares at the strike price that I'm selling the put at. Now, in this scenario, I am purchasing 1 leaps and I am selling 2 put options to finance it. So with all that being said, let's go into the computer and I am going to show you how I do this. And I have done this on several stocks and it has proven to be very profitable. Here we go. As always, before I open up a trade, I want to look at the technicals to make sure I'm getting the best entry for the trade I want to make. Now, I'm looking at a 3-month chart on DraftKings, and when I look at the technicals, I am noticing that $40 is the bottom of the Bollinger Band. And this is really a unique situation because we are over 50 on the RSI. So typically when we're over 50 on the RSI, if I am going to make a trade, I go right for the middle of the band. So this is a measure of safety because I'm going even lower and I am looking at that $40 strike for both my leaps and my sold put. Now let me take you into the option chain to show you exactly how that lines up with the way I like to make a selection on a leaps. Now I am looking at the option chain for DraftKings, and the first order of business is to look at expiration dates. So if you're going to do a leaps, you want to go at least a year out, and that gives the trade plenty of time to work in your favor. So looking at that, I am going to go down here to 9/18 of 2026 because that gives me a year for this trade to work out. So once I click on that expiration date, now I am going to actually look at the option chain. So remember, I told you that $40. I'm looking at that right here. Well, if I look to the left, this is the call side of the equation. And I also like this delta. I like to shoot for a delta of 0.7 to 0.8 for my purchased leaps. And this 0.7 delta right here, it is going to cost me $11.15 a share. So you have to multiply this by 100 because when you're dealing with options, you're always dealing in lots of 100. So that would be about $1,115 to purchase this leaps call option. So now that I know that, now I want to look right here to the left. This is the same expiration date, and we're at the $40 strike. It's the same strike. and this is paying $5.41 a share. So knowing that after I make this purchase, I can sell 2 of these and it will finance the purchase of this one Leaps. Now, something to keep in mind is as DraftKings goes up and down, this price will begin to change. It's got time to work in our favor, but I just want you to understand that after you sell a put or buy a call for that matter, once the stock price moves either closer to your strike or away from it, it does change what you see on the premium amount. But because there's so much time in this trade, I won't worry much about that, and I'll just let the trade continue to play out. Now, before we look at this on an option calculator, let's see how high it has actually risen. Looking at the last 52 weeks, right here at about that 53.37 mark. But I would expect if they continue to do well, then we might see it get to around the $60 mark or maybe even higher. So keeping that in mind, let's go look on the option calculator and we will see how our trade would perform. Looking on our option calculator, here is the $40 call that we purchased. The net debit currently is around $1,100. And then let's go to November. Let's assume that all the football talk starts happening and people start looking at DraftKings, they start using it, and now they're paying attention to this stock. If it gets up to that $60 mark right here, well, look, that is a $1,185 in profit. So if we click the profit and loss percentage for that same trade, you can see right here, that is going to give us a 108% return. And that is assuming that we paid for this $1,100 on our own. But remember, we sold those put options to finance this, so that would make this 108% even more substantial. Now, we just opened up this trade in our community today, so I'm sure there's plenty of time for you to get a similar trade in. Hey, if you like all the things I share with you, I want to encourage you to sign up for my newsletter. I send a lot of tips and tricks on trading in my newsletter, and I would love for it to be a way for me to communicate with you. Also, for those members in my community, especially the newer members that joined for the Buy Right Challenge, I want to personally congratulate you. You are now almost $1,500 richer in just a few weeks. And not only that, but you are learning so much. I see your questions. I love helping you learn, and you're all becoming more savvy at this game of trading. So I'm very excited for all of you, very excited for the community. Remember, if you're with me trading with Ashley, there is no trader left behind. Now, I had done other videos similar to this one. I am going to leave another video for you that will show you how this works when you want to buy a Leaps but get it free by selling put options. I'm going to leave that video for you right here.